All right, so let's see here. Yeah, that's on. Actually, let's start out with these charts, I guess. Okay, so my name is Derek Frey. I am the Chief Market Strategist at Karnak Investment Advisors. I will be doing a live look at the week ahead in the world of Forex through the eyes of harmonics, as always. So feel free to ask any questions anytime. Anything market related is fair game. I will go through my charts and whatnot and share whatever I'm looking at. Not that there's really that much going on this week. We're, of course, as all of you, I'm sure most of you know, we're still in the depths of the summer doldrums. The only kind of noteworthy thing that's happened in the last few days, of course, has been the comments from the ECB or from Draghi himself about their willingness to defend the euro. I don't know how many of you have been traders for a long period of time or follow central banks and their comments and the market's reaction to those comments much, but I've watched it for over 20 years now and paid actually quite close attention to central bank announcements. It's been one of my kind of primary things over the years as far as the one fundamental thing that I do pay a little bit of attention to, and mostly for this reason here. And the reason is Bank of Japan is the perfect example of this. They are the absolute worst central bank when it comes to results. They consistently say we're going to defend the currency, and then the market immediately moves, or not immediately, but ultimately moves to test whatever they just said. You can almost guarantee it. You know what I mean? When what happens. And the euro, I think, is now Draghi for some reason is playing that foolish game that the BOJ has played, where they straight out say we're going to defend it here, and then they have to back it up. Like for instance, the Swiss franc. When the Swiss of course, have recently pegged the euro at 120, and now they're spending billions defending that peg, which will ultimately come out. It's not a question of if the peg will come out. It's a question of when. Guarantee that it will come out. They cannot defend it indefinitely. It would bankrupt the country. So even if they own a printing press, it will bankrupt them through inflation. So it just doesn't, it's not a solution in the long term. And same thing with what Draghi said. It's in a way, it's good that he said it, but he really, in another way, he didn't need to say that. We all already know that. Everyone knew that they would defend the euro at all costs. There was never a question. I've been saying that since day one here on FX Street, and I'll say it until day 1 billion. There is no chance, and there never will be a chance, that there's going to be the destruction of the euro. And not in the next 5 years or 10 years at least. I'm not saying ever, but in our necessary time frame for trading, it's not on the table, and it never was, and it never will be. So that's just the extreme in Europe, just like we have our extremes here in the United States with, well, stupidity. Europe is really no different. They have extremes over there too, and that just happens to be one of the extremes of stupidity when you get otherwise intelligent people spouting the idea that they're going to break that thing up. All right. So anyway, my point is simply, now that he has made this announcement, the market is almost certain to go back and test his will. We've already seen it overnight, as you can see here from the retest off of the pushback off of the highs from Friday afternoon. We've come in almost 200 points, 150 plus points. To retest the lows We're back out of this chart a little bit. To retest the lows would be to retest 120, essentially. And here you can see we have a bearish butterfly pattern with a B point basically at 120, 150. So we still have another 100 points of downside potential for that pattern anyway. But I think beyond that, you're likely to see a test of the lows, because that's really what they're saying. When Draghi made that comment, the euro was already up here at 122, but he was looking back at 120 saying, well, basically if we fall below that, we'll have to step in. A number of you, if not almost all of you, are over there right now, like living in Europe, right? So why am I telling you? You tell me. What's the story? What are you hearing? What's going on? Come on. You guys are on the front lines. Spill it. What's up? Anyone? Bueller? All right, we'll come back to that. I'm going to jump ahead to the euro yen. You see we have some short-term stuff playing out here to the long side. I was pointing this out earlier this morning to the my people in my earlier webinars that there was some buys down here basically around the 95.60 handle, 95.50s. And it started to bounce. You can see there is still upside potential as far as the models are concerned, and you've got a AB equals CD pattern, bullish pattern in play here at the same time. So I'm looking for this thing to at least track back through 96s, but ultimately not necessarily looking for big follow through on the upside here, because of course this thing is, 50% euro, and like I've already said, the euro has a large downside risk right now until those lows are tested. Once those lows are tested and the central bank resolve is tested, then of course it's up to them to act. So then the risk flips the other way to being on the upside, because then once they do intervene, of course it will explode to the upside, because that's what their intervention is. Their intervention is just buying. It's not that difficult. Intervention is not like some massive shell game. You're either buying or selling. That's all you can do. So, in that case, they'll be buying. So, but for now, like I said, the traders have the power. Until they hit the buy button, the traders have the power, and they ultimately, like I said, will probably push this thing all the way to and through the lows to test and find out exactly where they are going to push the button. Canadian, I wanted to point this out too. There is a bullish Gartley pattern in the daily on a macro sense here. However, you'll notice the PRZ extends all the way down to 99, so there's still almost 125 or so points of downside risk, if you will. And the B point is only here at 101.50, so right now it's only got about 100 points of upside. But I do like this thing for the longer haul. I do want to be a buyer at some point, but for now there's a lot of, like I said, downside risk that I want to keep an eye on for the time being. But at some point I definitely am going to step in here as a buyer. The Aussie, you can see, has formed up a bearish butterfly now that we've basically pushed through the 105 handle. However, its PRZ can extend all the way up to, actually not too far, 105 teens. So there's a good chance that you'll actually get some reasonable sell signals here, at least for the short term. You can see the projection is to the downside. However, the Hurst is at exactly 0.5, so it's not in any way, shape, or form giving us a great projection. Here you can see the butterfly on a 30-minute, and it's just kind of drifting sideways in the projection. Here on the hourly, you can see there's a downward cycle even in the face of a rising market, and we're getting a sell signal up against the upper sigma here. What is this? Yeah, that's 24 hours. So it does appear that that's probably going to end up being a decent entry at some point. You have a similar signal in the Kiwi, of course, although you're not pushing up against the extremes here yet, so I wouldn't rush. I would wait for some strength back above 81 before I would look at that one. Not to go back on the BOJ and whatever, but we are near the point where BOJ has intervened before and expressed a desire to intervene in the past, if you will. This was an intervention here, if you recall. The 75 handle, of course, is the major, I'm on a weekly chart here since it's really long term, but is a major support level, obviously. But this 7750 is also a pretty major support level, being a 786 retrace of those prior 75 lows, basically. So, so far, at least, we've been able to hold these longer term lows, and I wouldn't be surprised if they do hold. And whether or not BOJ intervenes down here at 78 again doesn't really matter. You can see this bearish harmonic pattern did correctly call this thing on a weekly basis, though. But when we go back over to the daily, you can see the bullish pattern that's here. And if I go to a 4-hour, it's blown up even better. You see the B point's really only a move to 79, and we already got kind of one brief iteration of that pushing about halfway to the B point. So at this point, it's, a double dip. But I would be a cautious buyer if we did see dips back below 78 into the 77s again, and then basically run stops below those 7 down here. Looking for a snapback towards 79. I mean, you'd be risking less than 50 points to make over 100. It'd be a better than 2-to-1 risk to reward. So even if it doesn't work, it's not stupid. This one's already played out. What is this, the guppy? Yeah, this is a very short-term 50-minute bullish pattern that already played out. It was too small for me to even play, so nothing doing there. So for me right now, longer term, I'm looking at, like I said, buying some additional weakness in the Canadian, selling additional strength in the Australian, and really being extra cautious around the euro, like I said, and anything in the euro, whether it's euro yen, euro dollar, euro whatever, because, like I said, of the kind of outsized two-sided risk that we have right now. I would expect, some pretty big bars to take shape in the euro in both directions, downside and upside. Downside when we break near those new lows or break towards them, and upside when they finally do intervene, if they intervene. I mean, if they really do. So the probability that volatility is going to increase is increasing, if that makes any sense. All right. So anyway, that's my kind of 2 cents on the overall state of things. I'm going to go through some questions here. Welcome to the tough love session, Derek. Tell me. Not today. It's summer. Odd is showing an uptrend now. What advice and entry point for sell? Well, right now we are getting a sell point right here, right now. I'm actually going to be getting in on the short side as we speak almost. Because you're getting a sell signal. That's what my red arrow is right there. You're in the PRZ. The bad news is that the B point is only 104.73. So if you're just trading this little pattern by itself, it doesn't look that good. But there is a bigger pattern here. Yeah, there we go. I'll highlight it. This is basically what I sometimes call a broken bat, but it's not. Broken doesn't mean it won't work. Broken is it doesn't matter. Anyway, the B point's 102. So this is a daily chart. So this is a fairly big pattern. You'll notice that you've already had many iterations of this thing along the way that has worked. It's not why I'm doing it. I just want to point out. Oops. There we go. So here you had a smaller one, and you see it did play right out. Here you had another one. You see it did play out, and here we are again at a new, basically 1-to-1 ratio here between these two again. So 105, more or less, any major strength above 105 especially would be nice to sell into. You'll notice on the daily the Hurst has gone to 0.44, so there is anti-persistence in a more macro sense. I don't know why I keep talking about it. I got to actually sell it. Hang on a second. Okay. ECB intervene if euro drops to 80. Oh, you're looking at it the other way. Yeah, 80 would be no. Oh, you really mean 80? It hasn't even been that low when it first debuted. I don't think they'll wait till 80. That's what I'm saying. Based on his comments, he's basically saying that they're not really willing to let it go much below the prior lows. At least that's what the market will test. That's the theory the market will test. We don't know where they're going to intervene. I don't think he knows where he's going to intervene yet. I think in reality he hopes he's going to do what Greenspan did so well, which is jawbone the market. But I think you'll see this one's going to have an opposite effect. You guys are targeting 108.50 on the Aussie? Wow, you go. Oh, you're going back up to the old highs, I see. Basically up here. Okay. I think in the long run that you may be right, but I would argue that along the way it'll go back to something around the closer to 102, at least 103, and then continue on, like, you know what I mean? Then 106, and then back to 104 maybe or something, and then 108, from there. But I think we frankly can both be right on the Aussie here. Not that I care. I'm not trying to be right. I'm just trying to do the mathematically correct thing in the moment. But anyway, but 80. I mean, you're serious about the 80 on the euro? Are you hearing? I mean, you're over on that side of the pond, aren't you, Jack? Where are you? Are you guys serious about 80? Where do you get 80? This I gotta hear. I don't even think I can scale out that small. 80. Down here, huh? I mean that, and I don't trade that long term, so you could be right, and whatever. Honestly, that's so far out there. I couldn't possibly. I mean, even if all the piggies were kicked out or left, whatever, for one reason or another, left of their own accord or were kicked out of the euro, I wouldn't expect it to go to 80. In fact, in that case, I would expect it to go to 150. Yeah, anyway, those are way too far out numbers for me to even really fathom, so I'm going to come back into something more usable for the here and now. Let's go back to that Aussie, actually. That was interesting. Oh, that's easy. I don't trade the news, so I think trading the news is, statistically speaking, is pretty usually a bad bet. I mean, I was a broker for many, many years, and I've seen what happens during NFP, for instance. I mean, most of the time, with few exceptions, brokers make more money in 1 hour surrounding NFP than they'll make the rest of the month. That's like their Christmas period every month. Because more people will do more dumb things chasing after that movement than at any other time during the month, collectively speaking, at one time, So, I mean, it's a huge, huge profit because no matter what happens, most of the time, the retail side of the clientele loses. And they do so even in an exponentially greater fashion during the news releases. So, I mean, I don't, I just simply don't do it. There are some news trading programs out there that are pretty good that I'm aware of that can sometimes help get you a little bit of an edge, but for the most part, you're the way I look at it is, try to take it back to more practical terms. It's like scheduling a car accident. These big reports like NFP, I'll pick on. Like I always say, NFP stands for not for professionals or not for profit, because it's what typically happens for most people. So, I mean, it's like scheduling a car accident. If you knew that there was going to be a car accident at 8:30 in the morning at the corner of First and First, would you drive your car through the intersection of First and First at 8:30 in the morning? I mean, I don't think any sane person would answer yes, and yet that's essentially what people do. Even if you go through that intersection at 8:30, it doesn't guarantee that you're the one that's going to have an accident, but you simply know that there's a higher probability that you will have an accident if you put yourself in that situation. And trading around those major reports is nothing different. The probability that you're going to have an accident is greater, no matter who you are, how big and tough you think you are, how smart you think you are. It doesn't matter. The underlying volatility increases. Therefore, you stand a greater chance of getting your butt handed to you. And so do I. So does everybody. So that's that. The reason that we went, that I don't remember, frankly, and I don't really do fundamentals. So I did trade through it, but I don't. Off the top of my, well, we were going through the .com crash. The .com bubble was bursting back then, so correlation was still high with all that stuff. And that's when it debuted. That's what happened. Wait a minute, I know exactly what happened. 2000 is when the darn thing came out, or 99. And when it first debuted, it debuted at parity, at exactly parity with the dollar. And the idea was that it was basically, originally the thought was it was going to maintain something close to parity for some time, and then it basically fell on its face for whatever reason. You can ascribe all kinds of theories to why it happened, but the reality is nobody actually knows with certainty why it happened. Lots and lots of good theories out there, and you can pick whichever ones you like, but bottom line is that it did. But yeah, I mean, for us to revisit even parity itself is, it's possible. Anything's possible, but does it stand within the realm of probability right now? Absolutely not. At least not for like the time frame that I'm trading, the next few weeks, maybe even the next few months. But I don't trade any longer term than that. So I couldn't possibly look out that far. Okay, I have no idea how to say your name. I'm just calling you Plumber. I apologize. S. Okay, we'll go with S. I read an article about how hedge funds are paying brokers like TD Ameritrade, Scott Trade Exchange to their retail orders and trade against them. Most retail orders never make it to the exchange they go to hedge funds to trade against. I was flabbergasted. I read about that. Hedge funds are literally paying on retail traders. It's tough to follow the hedge funds have. Yeah, I mean, sure. They figured out that FOREX figured it. The same thing FOREX figured out, that at the end of the day, the retail, ultimately, their decisions are poor, and it's not really predatory. It's just a reflection of mathematics. Okay, like they didn't. I want to point that out. They didn't create this. Okay, they're taking advantage of this. Do you understand? I'm not defending it. I'm not defending it at all. But I just want to put it into proper perspective. Okay. It is in the retail trader's natural human nature to lose. That is what has always happened, and that is what will always happen, because it is their basic human psychology that creates that. Okay? So they're simply realizing that fact that, yes, the average retail trader will lose. Therefore, if I take the other side of the trade, I'm going to win. So why not take the other side of the trade? I mean, from a trading, I run a CTA, which is, basically a hedge fund. And from a trading perspective, I have nothing but respect for that, because they're doing the mathematically correct thing. Absolutely they are. Now, is it predatory and does it kind of suck and seem shady and all that? Yes. But I cannot argue with their math. Well, it's no different than Forex. The vast majority of retail order flow never goes anywhere. Even if your dealer passes the order on, they're just passing it on to somebody else who's taking the other side of it. It's not like it's going, you know what I mean? And even in the stock market, if they did pass the order directly on into the actual exchange or whatever, it would still ultimately, if you're selling, somebody else is buying, they're taking the other side of your trade, no matter what. I mean, for the market to exist, a person has to take the other side of your trade. So it's not really, you know what I mean? Like, whether it's a hedge fund or Joe Blow, honestly, what the hell do you care? What does it matter to you who's on the other side? Unless you think the other side has control. That's a whole different story. Do you see what I'm saying? Like, who cares who's on the other side? Somebody has to be on the other side for you to execute the trade at all. Well, that's a question that I would argue you have to take back to your regulators, because it's the rules and regulations that the government set up that are basically not creating a level playing field, and that's up to y'all. Do you know what I'm saying? You know what I'm saying? And again, I'm not justifying it. Not necessarily agreeing or disagreeing with anything you're saying. You're right. It is what it is. You're pointing out the reality. It is an unfair playing field. Yes. But that's the way the field was set up. And we didn't set the field up. Okay, we helped a little. But anyway, what's the statistical advantage in harmonic patterns percentage-wise? Pizzazz is asking. 70% is the baseline. I mean, you can tweak it with different ways of filtering to get, whatever, obviously higher or lower than 70, but 70 is the traditional baseline that most people that run tests can validate. I've run tests as high as 92%, but I mean with harmonic patterns specifically, but I still, the baseline is still 70. On a daily Australian price is zigzagging up. Is this a bullish pattern or bearish for sell? Well, I have a bearish harmonic pattern. The zigzagging up and down itself is this zigzag pattern. I don't really have any comment on it other than it's a very well-defined range, ascending range, and we are up against the upper end of the range. So you would argue that if you got a retest of the range of the lower end of the range, is probably going to be, like we just said earlier, somewhere around the 103 area, and then it could resume the upward march, like you guys were saying, back towards the 108, ultimately towards the 108 handle. $95. So the bearishness comes from, for me, for the harmonic pattern, not from the zigzagging itself. The zigzagging is kind of circumstantial relative to the pattern itself. And there's another pattern here too, but it doesn't matter. Yeah, I mean, I kind of agree with FitRunner. Either you have an edge or you don't. And they really are just kind of taking advantage of whatever edge is available to them. High frequency trading after has access to retail order flow, they're going to see price. Well, honestly, I wouldn't feel so jealous of all that special access that they have, because what you really should do is go look at the actual results that the average hedge fund gets. They kind of suck, to put it nicely. You know, I mean, they're nothing to aspire to. The average hedge fund is not doing really much better, if any, than anybody else. They just have more money to lose and more ways to lose it. I mean, honestly, okay, Joy, as part of butterfly pattern, can you see Aussie drop to 96? You guys are like way out there with these numbers, way back down to here. I mean, my God, sure, but to get to 96, it's got to go to 103 first. No, not really from this pattern. This pattern doesn't have that much energy stored up in it to get it back to 96 of its own accord. You can measure the energy. I mean, there's a technically, a way, a hopefully scientific way, at least that I've devised, of calculating the potential magnitude, or I should say energy potential, therefore possible magnitude of movement from a pattern. Because as I was explaining, I think earlier, or was it in this webinar or was it another webinar? I do 3 of them on Monday, so bear with me. I forget what I did where sometimes. But these patterns represent a storage of energy. And, you know, as really anything does. In nature, nothing moves without energy, right? Nothing happens without energy. Energy is everything. It's not just nothing happens, but energy is everything. And so energy gets stored, and then it gets utilized. It doesn't get used up, of course. We know that energy just gets transferred. But it still goes through a storage and a recharging and then a utilization phase. And the pattern, while it's building, is the recharging, essentially. And then the pattern playing out is the release of that energy. And anyway, you can calculate how much potential energy is being built up through the storage process, and therefore that's going to tell you roughly how much magnitude can be statistically expected. And I can just tell you straight up, in this particular case, be lucky if you could find parity out of this one. And even that's a huge stretch. That only is about a 30% chance. 103, on the other hand, is about a 70% chance. Now, if we get to 103, of course, parity becomes the probability that we get to parity increases. But from here and now, it's still low. It's still less than 50, based on this particular pattern. I'm not saying overall. I have no idea overall. I'm not looking at it that way. I'm looking at pattern to pattern to pattern. Yeah, like I said, if you look, you'll see most of the hedge funds' performance is nothing to like I said, aspire to. It did start going back again. Good. Okay. And Canadians holding. Derek, I like Derek's sessions because his discussions are somewhat off the charts. You can get lessons on technical analysis anywhere, but these discussions provide context and understanding how the market actually works. Oh, cool. Thanks, man. That's actually quite a compliment. I appreciate that. Harmonic pattern, only one pattern. Well, yeah, of course. No, that's not true. There's like in this one I happen to have on the screen right now, there's two patterns here at once. They share a fairly common PRZ, but they share a common PRZ, but there is two patterns here at the same time. But they're both saying the same thing, and it did go do what they said it was going to do, which was up. But there can be more than one. There's often more than one in different directions on different time frames, so that can get kind of fun. Confusing. Did you expect Swissy to hit 99 range again to short it? Swissy. Where did my Swissy chart go? Oh, yeah. Well, if based on what we were talking about earlier, the idea that I'm trying to trade it, based on the idea that Draghi's words will be tested, that and of course the patterns that I've got that agree with that, but I would have to say yes because we're not that far away. First of all, we're already at 98 and change. And so, and you can see here the models are projecting continued rally here as not in the immediate future, but in the longer term. So yes, I think you will get another opportunity at 99. Here's the bearish pattern that's played out a little bit, then went further and has played out pretty well. You can see it's been pretty messy though. The B point has been already hit once and we've bounced off of it, but you could actually see this thing follow through. Here's the longer term one that's in play. On a daily, you have a B point all the way down here at 93. But you can see that the PRZ is still up here all the way even at parity. It's a crab too, my favorite. So yes. Excuse me. Of course. In 2011, hedge fund has lost my average. I mean, I assess myself. I feel like, yeah. Do you, any traders or fund managers that trade yards, I'm not sure if it's a term, or $1 million pip sizes? Yeah, a yard is $1 billion. And usually you're trading like a yard inside of a month or sometimes even a few weeks. Excuse me. But no, I don't. I've never traded like a yard as a single position. No. But yeah, there are traders out there that do. I'm sure I will one day. I haven't built it up that big yet. But I mean, whatever. Honestly, it doesn't matter. I've been doing this 20 years. I've traded everything from the little pissing at $5,000 accounts to, the multi-million dollar accounts, tens of millions of dollars. And honestly, okay, look at my thing right now. This is a real position. I'm in a 10 lot. I'm in $1 million right now. And notice right here, do you see my mouse? How I have the profit set to just points. I'm not watching the money. That's one of the secrets. You don't watch the money. You watch percentages and you watch points, but you don't watch the money because mostly you just watch percentages, but I can do the percentages based on the points in my head. So you desensitize from the dollars. So for me, whether I'm trading 10,000 or 10 million, it doesn't change anything in me. I trade exactly the same. I could care less whether it's, you know what I mean? Like I'm not emotionally affected by being in 10 million versus 10,000. It has no effect. Basically because I don't look at the money at all anyway. So how can it have an effect? I'm not thinking about it as money. I'm just thinking about it as percentages. And percentages are not something you can really be very emotional about. Money is something you can't help but be emotional about. That's why we don't think it. That's why we don't look at it. Because it lies to you. You know what I mean? Like, because you have at the end of the day, when you run a fund, you win or lose more money than the average person will see in a year, in some cases a lifetime. I mean, I'll routinely rip through $100,000 in an hour. No problem, on a few bad trades, and then make it up maybe a few hours later, whatever. That's okay, whatever. So if you actually think about that, yeah, that can make you crazy because $100,000 to anybody, to me, is still a lot of money. You know what I mean? That's at least a good car. So, I mean, there's no question that if you look at the money that it will affect you and all of your own personal emotional baggage about money will come into play, which is why we don't look at it. That's why we just look at percentages and raw numbers. Because dollar signs will make you emotional. So you're not going to be a better trader by being emotional. So take away the dollars. Can you explain when pattern end? How do you know price will pull back or continue? All right, you will never know. There is no way to have certainty. All you'll ever have is percentages. All you'll ever have is probabilities. You'll never have certainty of knowing, okay, it's done, it's going the other way. Anytime anybody says that, they're full of crap. They don't know that. They're just saying it. You can't know that until hindsight can prove it. But you can't know it in the moment. It's not possible. So we're just guided by our probabilities. What is most likely, statistically speaking, to happen using the tools that we have. So the pattern will end when the statistics change. That's the best thing I can say. I mean, statistically speaking, I'm usually targeting a move towards the B point, the place where the two triangles kiss. And but is that that's certainly not the only way, is what I'm trying to say, to look at these patterns by any stretch of the imagination. That's just the way I have developed it. Oh, I'm running out of time. Oh, I don't trade the patterns as they're building. I only trade once they're completed and built an actual pattern. Like right now, in this thing, there's a bearish pattern. And like I was saying in the Aussie, if I go back over to that, that's one that I actually just got into. Here's it's better if I show it on the 4 hour, I think. Yeah. Actually, I'll show it on the 15. I think there's yeah, there is. There you go. So I waited for this pattern to show up, and we were talking about it earlier when we first started this webinar. And it was up basically at 105, kissing 105, and I sold short at 104.95. Now, that's a big deal. I'm up 10 pips. Whoop-de-doo. Who cares? Not even because of the spread. I'm only up 6, I should say. But yeah, I'm only trading it now once the pattern's completed, because then, like I said, that represents the real signal. The real signal occurred here. All this other stuff. Some people do trade the construction of the patterns. I have a friend who does, Sunil, on here on FX Streets. Sometimes he presents. He's doing a live seminar down here in Florida with Rob Booker in a few weeks that I'm going to go down and visit with those guys, because we're friends. We all did the ITC at FX Street in 2008 together, and haven't seen each other since then, at least at one time. So we're all going to hang out again, which should be fun. But anyway, my point is, I know he trades the patterns as they're under construction. So I'm not saying that he's right and I'm wrong, or I'm right and he's wrong, or anything. It's just different personalities, different ways of utilizing the information. But I prefer to just use them. I'm lazy, I think is probably what the real answer is. So I try to keep it really simple, and I don't want to think too hard. For the Hearst, I want to see as much anti-persistence as possible in conjunction with in conjunction with a PRZ, if that makes sense. As much anti-persistence as possible within a PRZ. Yeah, that's going to be sloppy, and that's going to be sloppy. All right, I think I'm going to wrap it up. Is there anybody behind me, FX Street? Do I got to wrap it up? I think I do. There's somebody right behind me. So be safe. Have a good week. If you don't know what your edge is, you don't have one. It's great to have an opinion and all that, but your opinion is really worthless. I mean, everybody's got one, and I'm still shocked in the year 2012 that the modern human animal still thinks that trading his opinion is the appropriate way to trade a market, when, you know what I mean? Like, all evidence is to the contrary. But that being said, whatever, please keep doing what you're doing, because it's definitely feeding me. Anyway, thank you, FX Street. As always, I really appreciate you having me here, and I will be back again next week. We'll do another live look at the markets through the eyes of harmonics, as always. And if there's any questions, feel free to email me. Anybody who's interested in working with my managed account through my CTA, obviously just email me as well. And I will see, like I said, see you all next week.